Hi everyone, it's David Gellner and Parker Sadakis with the Gellner team of Kidder Matthews. We're here today to give a quick shopping center update for the month of August in the Pacific Northwest. Parker, you want to talk about what we've seen as far as sales and on market this
Definitely.
month?
Yeah. So in August, we saw 14 new multi-tenant properties hit the market, 4 sold. In July, 14 centers hit the market, 5 sold. So it's been fairly consistent over the last couple months on what's coming out and what's selling. I do think it's just interesting. It's really not that many quality shopping centers coming to market. So, the properties that we have on the market that I know you'll touch on, but gotten quite a bit of activity on those just because for a buyer out there looking for something quality, 4 deals on the market in August, there's not a lot to pick from.
Yeah, as Parker mentioned, one thing we'll mention before we get into some specifics on deal stories or case studies is in the multi-tenant side, similar to the single tenant side, is we still continue to see a big segment of buyer pool and demand focused on the $5 million and under price point versus the $5 million and above price point, as well as predominantly the buyer pool has been focused on smaller shop space type assets versus the boxes, which demand, there is still a good amount of demand for those. However, the cap rate spread is pretty considerably different than a multi-tenant shopping center with smaller shop space. Specifically speaking, we're seeing a lot of demand on the multi-tenant shopping center side. We just put on the market $4.4 million shopping center in Covington, turnkey asset, everything's been done. Asking cap rate on that going in on current cap is a 5.7% cap rate with significant upside down the road because the average market rent or the average rental rate currently on that is $22 a square foot. And if you look at the market, we're seeing leases for shop space in the 35 or above rate. One other interesting thing that's been unique this year and latter part of last year is we are seeing more multifamily buyers enter the space. And specifically on that Covington deal, we went on the market 7 days ago. We've had 16 confidentiality agreements signed and, expect multiple offers on that. So shopping centers, especially the smaller shop space ones, it's a very in-demand market, probably the most buyer demand we've seen in the last 10 years. You want to talk about kind of owner-user and the Tap Plastics deal in Linwood?
Definitely, yeah. So we had a 2-tenant, 2-space building on the market or have it on the market in Linwood. Also, significant amount of activity there. We received 3 offers in about 3 weeks of going on market, went under contract, and we'll be selling it above our asking price. But it was a driver there as well. There was a vacancy in the building and owner users. I know we touched on this on our single tenant update as well, but owner user demand is still extremely high. So, the group there really like the income on the neighboring space, is going to put their own business into the vacancy. And, for a pro forma cap rate, that's going to be in the low 6s, assuming a market rent on that vacant space. But yeah, we just were astounded with the amount of activity there driven by owner users that wanted the vacancy.
And a big part of the owner user demand right now is we continue to hear from purchasers who want to purchase a building to occupy, one of their businesses in the property is one, financing costs for owner user purchasers is very attractive right now, much more so than a typical investment sale purchaser. And then also we continue to hear that the cost of going through a lease up and tenant improvements in a building that they don't own, the owner users won't own, that's, become less attractive if there's options to purchase just because we have seen significant rental rate growth on the retail side of things in the last year to 2. And so we expect owner user interest to continue. The other part with that we're seeing that drives the owner user activity and then also into our next topic is we're still seeing 3% or below retail vacancy rates in the Puget Sound, especially in certain markets with shop space. We have seen an increase in box, medium, and big box vacancy rates because of, the Walgreens closures and then Rite Aid's bankruptcies. But if you take out that segment of the retail industry and just focus on your typical multi-tenant shopping center, occupancy remains extremely high, rent growth is high. So it's really multi-tenant shopping centers time to shine, which, we love to see. What are
Definitely.
you seeing as far as cap rates and what do you think is going to happen with the expected interest rate cut this month?
Yeah, I think with the inspected interest rate cut, most of the pricing's probably already built into the market. We spoke on this on our last market update as well, but in a typical market, the spread between your interest rate and a cap rate would be 150 basis points to 200 as a kind of a good range. I just got a email from a client, and that's what he's still looking for. However, like you mentioned on Covington, that's a 5.7 cap going in. We've gotten a ton of activity there, and debt might be 5.7, so it's right debt neutral. So we're still seeing a ton of demand, even though the spreads are typically below 50 basis points for a lot of these. And I think as we move forward, maybe we see a little bit of cap rate adjustment, but in reality, it's been built in for probably a year now, and buyers are just getting really aggressive on those spreads.
Yeah, I would just add, on the pricing front for multi-tenant shopping centers, we've been at for the last year near or at peak pricing. In some cases, it's even better than peak pricing. Interest rates really haven't factored into, at least in the Puget Sound, our pricing component, simply because there's overwhelming demand for the current inventory, and especially big asterisks here on quality inventory. So, especially the assets that are 2000 or newer, we're seeing really premium cap rates as far as that. And again, a lot of the buyer pool and a lot of the purchasers for these assets are first-time retail purchasers. A lot of the legacy groups, as Parker mentioned, still target historically a point and a half to 2 point spread between current interest rate and going in cap rate or pro forma cap rate. But these new purchasers, they're trying to get out of, multifamily assets, selling their assets there with the regulatory burden in the Northwest now getting tougher and tougher to operate those. And then the triple net leases are extremely attractive to those groups because, they've seen operating costs rise significantly, and that just hits the net operating income's bottom line. Whereas retail, like we've been talking about, great asset to own in inflationary environments, or when you see operating costs go up, simply because a lot of those expenses, if not all of those expenses that rise, are passed through to the tenants and not necessarily affecting your bottom line and your cash flow. We expect that to continue. Shopping center demand, see no reason why that would not continue, simply because, in our states, it's very difficult to develop a multi-tenant shopping center. The overwhelming amount of developer demand for this product that we're seeing get constructed is single tenant or 2 to 3 tenant, maybe little shopping centers like that. However, the strip retail with 5 to 10 tenants in a row, we're not seeing that and haven't been seeing that get developed. It's very rare. Whereas if you go to an Arizona, a lot of land to be built, a lot easier to build properties out there. So really in the Pacific Northwest, we're insulated, and that's why cap rates have compressed so low. So it's a really good time to own a shopping center. I think it's a great time to buy a shopping center because of the rental income growth that we see happening continuing to happen in the foreseeable future. If you have any questions on this report or anything specific that we can help out with, we're here to be a resource for you. So please reach out anytime, and thanks for listening.